You have seen this. If you remember, right, this is the formula for approach of dividend policy. Okay, you all must have studied in your dividend policy chapter of financial management and hypothesis in the BVM, that is business valuation management, and all financial analysis in the final paper. This is what you get in the book. Okay, it is provided to you at the beginning of any chapter, and nowhere it is mentioned how did we arrive at this. Okay, nowhere it is mentioned. I haven't found any chapter material which is explaining the derivation of this. I would like to make you understand, and I would like to clear a concept providing you with the derivation. Look at me. You know what? According to Modigliani-Miller, R is equal to K. R, the rate of return that we earn, or the internal rate of return, is equal to K, the cost of equity. That's what Modigliani-Miller assume. Okay, since R is equal to K, whether I write R or K, it is the same. Okay, done. You all know shareholders do get return. Shareholders do get return. The return can be split into two parts. One, the revenue return, and two, the capital return. Okay, the revenue return is nothing but D1, the dividends. The revenue return is the dividends. The capital return or the capital gains the shareholders will have will be in the form of the increase in the market price. Okay, the market price will go from P0 to P1. Okay, so there are two returns the shareholders will enjoy. One, the dividend, and two, the increase in the market price. If I can split this, I can write, could you please zoom it, D1 by PO plus P1 minus PO by PO. D1 by PO is the revenue return, or the percentage of return, you can say dividend yield, and P1 minus PO by PO is the capital gains. Okay, so if I can add those things up, we will get D1 plus P1 minus PO by PO, okay, is equal to R. R is nothing but the return, total return the shareholders will get, since Modigliani-Miller assumed that R will be equal to K. Whether I write R or K, it is the same. So I will write K instead. Okay. So if D1 plus P1 minus PO by PO is equal to R, or for that matter K, I can expand the formula to this: D1 plus P1 minus PO. PO goes here and it will get multiplied by K. It will be POK. Done. Now come to this: D1 plus P1. PO goes here, so PO plus K. Rather PO plus POK. Here D1 plus P1 is equal to PO. You take PO as common, and 1 plus K. Now here D1 plus P1, you divide this by 1 plus K, and it will be PO. So PO is equal to D1 plus P1 divided by 1 plus K. Okay, this is how it is derived. Okay, this is one of the derivations of the formula. Okay, I will come up with another video where I will be telling you the cost of equity, where dividend and other things are also taken into account, and the value of tax advantages will also be taken into account, surely. Until then, Ramnath signing off. Tata, bye bye, Shabakar, and take care.